Good evening, everyone. If anyone can hear me and see the screen, if you could type something in that question box and let me know we're coming through okay, that would be helpful. A little sound check, if you will, just to make sure that everything looks okay. It looks okay on my end, but until you tell me, then I'm not really sure. So I need some brave souls to step up to the plate. And there we go. Okay. So a little introductions. My name is Roger Tricco. I will be presenting today's program from Capital Markets, the Cap It All. Today we have a live webinar, and this one is entitled, Which Indicators Deserve Your Attention? You will hear me talk about you and your, and I do that purposely so that I emphasize the you and your because trading is all about you. We're going to go through some things today to give you something to talk about, or to think about rather, pardon me. I'll talk, you think. But it's not to say that this is the only way to do it. If you have preferences of how you like to do things or see things, by all means, be my guest. That's what you want to do. That's what you should do. So that is why I say you and emphasize the words you and your within that. Anyway, back to the program. This is an interactive webinar, so that if you have questions on anything being presented, please type your questions in the question box and I will be happy to come up with an answer for you. Also, at the end of today's presentation, I will stick around for a few minutes in case you have anything of questions that we discussed today. I will be happy to answer your questions at that time. With that, let's see, we need to keep our legal department happy. And therefore, we have a little disclaimer that we need to share with you. This is our disclaimer. I'll give you a couple of minutes here to read through this. This is good stuff to know. And it keeps our legal department happy as well. Always talking about capital markets, the elite group, UK. I'll let you read through that. Give me a chance to get a little sip of water here. You may hear me pause now and then. I'm typically just getting a sip of water to keep me wet so I keep talking here. Give you another second on this. It's not too long. All right, I think we would have had time to get through our legalese and disclaimer. Let's move on. So with that, what are we going to talk about tonight? Well, we're going to look at how to determine which indicators offer the most reliable clues when trading various instruments, instruments being markets. Number two, advanced techniques for when to or when not to rely on RSI, MACD, and stochastic oscillator. I'll go through a little brief definition of each of those. Number three, how to use Fibonacci retracement levels and which timeframes offer the best results. Number four, strategies to day trade and swing trade different assets depending on your liquidity requirements. Now, before we continue, pardon me, a little definitions here. I am a fan of definitions, and not knowing what sort of background you come into with this for this particular webinar, I will be giving definitions as appropriate. so that we are all on the same page and nobody feels lost. If this is background information for you, then I simply ask your indulgence to hold through this for those who are not as far down the path that you may be. Okay, first definition up, day trade and swing trade. Day trade is kind of self-obvious, where you are day trading in the sense of your trades, you enter and exit your trades within a given trading day. If you are a full day trader, then at the end of the trading day, you are flat, meaning you have zero positions available or open rather in your trading account for that day. Doesn't mean you don't have longer term trades in there in your account, but as far as your day trading aspect, those are all closed. A swing trader has a slightly longer time perspective, and a swing trader is going to hold positions for a few days or a few weeks. So the swing trader is going to be using higher time frames in which to place their trades. The day trader is, by contrast, going to be using the lower time frames because those will allow trends or setups, whatever it happens to be for their strategy, to play out. Whereas as on a day chart, day time frame, a daily chart, it would not be able to be sufficient for a day trader. So there's our first two definitions, just to put us all on the same page. All right, now, a lovely white screen. That'll blind you for a moment. The reason I have this white board, if you will, up there is that I wanted to talk about Fibonacci and the Fibonacci retracement. But more specifically, I wanted to give you a little background on Fibonacci and what it comes about and some other such things, just so that you have an understanding of that itself. The Fibonacci retracement tool is named after a person, surprisingly enough, Leonardo Fibonacci. That's my best Italian accent, sorry. This is, okay. He obviously was an Italian back in the Middle Ages or Dark Ages, whichever it was there. A little fuzzy on my history. 1100s anyway. And as a obvious mathematician, well, maybe not so, he was a mathematician, if I didn't say that. He created the Fibonacci sequence. Okay, what is the Fibonacci sequence? All right, I've got my little pen here, and this is why I have the whiteboard up here. So, two numbers. Well, on a timeline, we have 0 as a starting point. The next number would be number 1. Leonardo said, take two numbers, add them together to get a third number. So 0 plus 1. This is high math now, folks, so stay with me. Just kidding. 0 plus 1 is obviously 1. Now, the next two numbers, 1 plus 1 would be 2. 1 plus 2 is 3. 2 plus 3 is 5. Oops, that's a 5. 3 plus 5, 8. 8, 5, 13. 13, 8, 21. I think you get the gist by now. Ad infinitum. Okay, so you can say, all right, so we come up with a sequence. Yeah, anybody can do that. True. So what? Good point. So what Leonardo did, let me get another couple numbers in here. Let's 34, 3 and 1 is 4. 34, and then one more, 50, that'd be 55. And you'll see in a moment why I said that. The key trigger to this is, okay, you say, so what? Well, here's the so what. If you take, after you get through these low numbers, any two numbers, consecutive numbers, divide them by another. So we take 55 divided by 34. That equals 1.618. Make sure you get that decimal point in there. Okay, again, interesting. So what? If you come out to here and take two numbers and divide them by another, you get 1.618. Take another two numbers, P and Q here, I don't know, I'm making up. Divide those together, you get 1.618. That's the critical part. This is called the golden ratio. So as you go out ad infinitum, any two numbers, divide the higher by the lower, you will get 1.618. Okay, what again? So what? Well, what we have found is in nature, this ratio holds true, whether it's sunflower seeds in their configurations, the nautilus shell, if you cut a nautilus shell, which is a mollusk, if you cut that in half, the various chambers follow the sequence of 1.618. We've also found that in architecture, this ratio holds true as it's more pleasing to the human eye. Pardon me. All right, all well and good. What if we flip this around? What if we say 34 divided by, if I can make another 5, now it's equal to 0.618. And again, if you flip these two, go down out on the timeline, or the number line rather, the sequence line, take these, flip them around, you get 0.618. Q divided by P, 0.618. That's the spooky part. Now, if you skip a number, so you go 55 or 21 divided by 55, then you get 0.3384. Ad infinitum, you get that same ratio. So this is how we get the ratios for the Fibonacci retracement tool. I just wanted to share that with you so that you'd have some background as to what these came up with. And I'll be showing you the various ratios on the chart. All right, now that I've done my beautiful artwork, we'll erase that, go back to that, and there we go. Now, live market analysis, how about that? So much for the PowerPoint presentation, and there we go. My kingdom for a chart, as the saying goes. Okay, 1 second here. Okay, I have a number of markets that we're going to look at. While I've pre-selected the markets, these are the bigger, more popular markets that may be used. I chose them for that, but I have not gone through to cherry pick any specific things. What I want to show you is how I go about looking at markets and looking at the charts. And so for that purpose, I'm going through how I do things. This is how I set up my charts. I have the chart here and then my various indicators below. My moving averages are here. I use a simple moving average. You may find something different. I use 10, 20, and 50. And if I'm looking for a long-term moving average, then I would use the 200. Most concerned with the 10 and 20. As we can see here on this particular trend, the 10 and 20 held on those pullbacks going up. So therefore those become important. But in the trend, we want to have the 10 above. 10 in my chart is in green, 20 is call it what it will, blue, purple, whatever, is the 20, and then the red is represents the 50 period moving average. So anyway, that's how I set up that. Now for the indicators down below, this is RSI. That stands for Relative Strength Index. RSI is an oscillator, meaning it moves back and forth. It has a range. It cannot go lower than 0 or higher than 100. Let me get rid of two things here. Let's see, chart settings. I don't want the watermark on there. And volume. There we go. Okay, there we go. There, that's better. Okay, a little cleaner for my purposes. Again, if you want them in there, be my guest. RSI. So this goes from 0 to 100. It cannot go higher. It cannot go lower. This is MACD. MACD stands for Moving Average Convergence Divergence. And MACD is created by a couple of things. We have two moving averages here, a fast and a slow moving average, or lines, if you will. With the stochastics is down below. With MACD and stochastics, I don't worry about the names of the lines. I just want to see I've got a fast one and a slow one. To me, that's all I care about. So MACD has a fast and a slow. As we can see, the light colored in here is the faster moving than the red. We know this because the light colored crosses below the red before the red is ready to drop. So that makes it faster. The histogram in between simply represents the gap or the distance between the two lines, the fast and slower. MACD is an oscillator in the sense that it moves back and forth, but it does not have a range. So we can see various values depending on the market and time frame for MACD, but the difference is that now we will see positive and negative numbers. So we see our 0 line is right there, and then numbers or the values below, as you can see over here on the right, are negative. Those above are positive. Down below are two stochastics. Now I have two just to show you the difference. This one on top is fast stochastics. The one below is slow stochastics. And while you can see they represent very similar movement of their own, you will see that the fast stochastics has a lot more movement within that, and the slow is a little smoother. And then once again, they have the fast and slow moving lines. Now, the difference or the similarity to RSI that in stochastics is that they have a line here at 70 and 30, just as we have up here for RSI. How that can be used is when the indicator is above 70. This is designed to show that the values or the indicator represents oversold. I'm sorry, I beg your pardon, I was looking down here. Overbought. This is overbought area, meaning when it falls down, if you were long a position, then it would be time to get out. Conversely, when the indicator is below the 30 line, this is the oversold area. And when the value moves higher, this is the time to buy that particular market or that particular time point in that. Now that is what the textbook tells you how to use them. If you have a different way to use them, if you have a different strategy, be my guest. Now, are these the only three indicators? Certainly not. If we come up here, click on indicators, these are the studies or indicators, same thing. If I scroll through, you can see this platform offers a wealth of indicators and studies, or studies, depending on what term you want to use. No right or wrong, just as long as you understand the concept, that's what counts. So anyway, I'm going to show you these today. These are the ones that I use. If you like them, great. If not, again, it's your choice. You choose those studies that are helpful to you. 1 second. A little sip of water there to keep me going. Okay. Is one better than another? No. When you are choosing which indicators to use, just make sure that you're not using multiple of the same concept. If they're showing you the same thing, for example, if they're showing you momentum, as an example, and you've got 3 indicators all showing momentum, well, that's not really telling you anything different. It's not complementing one another. So therefore, not much benefit to adding those in. So if you have something that's a little different, then that's going to be better. All right, so slow and fast stochastics, let's start with them. What's the benefit here? As we said, fast stochastics is going to have different uses. 1 second. Pardon me. And the fast obviously is going to react more quickly. For example, right there, we can see how fast comes down below the line, pops up above the line, and then drops down below the line again, representing this little movement right here on the chart. Now, slow stochastics has a little sideways movement corresponding with this upward movement before moving down. So the slow is a smoother line of how it moves or represents what price action is doing. Because of that, let me back up a second. Stochastics in general has the benefit of being useful in sideways, choppy, or range-bound type markets. So if that's what your style of trading is, if you have a range-bound market and it is just bouncing off of support and resistance as an example, then that would be a place where stochastics could be of benefit. Depending on the time frame that you're trading, and today, or on this particular chart, I have the daily chart on there. 1 day, each candle represents price action for 1 day. The fast stochastics can offer a benefit in the faster time frames, meaning the lower time frames, 60-minute, 30-minute, what have you. Pull that up here. So you got 15, 30, 1 hour. These are the faster time frames where the faster the fast stochastics can offer a benefit if that's your style of trading for day trading. In the longer time frames, if you're a swing trader, then perhaps the slow stochastics down here at the lower might be better for your style of trading. I say maybe, might be. These are all weasel words. Yes, they are. It's just whatever works better for you. I'll give you some ideas of how they've been designed and how people can use them. But when it comes down to it, it's really your input of how you want to approach this and what your strategy is of working with the markets. Okay, one caution on stochastics, particularly the fast stochastic, is it has, because it is fast and moves quickly, it has the potential to give you a false signal. So just be aware of that and use other indicators, other studies to confirm what you see on the chart, as well as what you see on the indicator, which ideally is going to confirm what we see on the chart. That would be obviously the purpose behind that. Okay. Let's see. Oh, MACD. I talked about how to use stochastics. MACD, I mentioned the zero line right there, which would be the bottom of those green places or the top of the, I don't know, what do you call that? Purple, lavender. I'm sure some art student would give me some other name for that color. But anyway, you know where that would be. That's your zero line. As the MACD indicator crosses above that zero line, that, according to MACD, would be a buy signal. So right, let's see, which is the fast line, the light colored. So there on here would be the indicator to buy. Maybe you wait for that pullback and go up. Okay, that covers it. When MACD crosses below the zero line, that is the time that you definitely do not want to be long. Now, hopefully you would have had something to take you out earlier, but just mirror image, maybe you're going short. If you are that style of trader, then when MACD crosses below the zero line, that would give you the signal to look for the setup according to your strategy of what would be appropriate to go short for that particular market. And here's a great example. Let's say you saw it here, the pullback, you thought that was a good place to go short. Lo and behold, it did. Whether you got out down here or held it further, whatever your style of trading might be, a great opportunity based on MACD that here we go, we're heading down. We've already seen some rollover on the chart. We're looking for a setup. There's a potential setup perhaps, and then we're going down. Our 10 and 20 in the proper order, and then we go from there. So there's an idea of how to use MACD. From the time frame perspective, RSI and MACD are applicable in any time frame. Your stochastics, because of the slow and fast, have the benefits for the higher and lower time frames. MACD and RSI can be applied to any time frame because it's going to take the information from that particular chart and therefore time frame in order to create what you see as the study involved in there. Sorry, I'm a little short on water here. I failed to get some before we started, and so I'm trying to make it last. But anyway, back to the program. Now, a little bit about RSI. RSI is or can be more useful in trending markets. So we see, in this case, Apple right now trending there, and we see RSI trending along with it. Here we have a large trend here, and we can see RSI hitting higher highs, but making higher highs as the price makes higher highs as well. So we said stochastics is good for sideways, choppy markets, range-bound markets. RSI, good for trending markets. MACD is also good for trending markets. So if you find something in a trend, then we're good for there as well. Now, we look at, let's see, how do I do this? Baseline, and right about there. And let me put another one down here. Okay, within this area, we can see that Apple, through this time period, has been somewhat range bound. Now, we can play that. Do our indicators helpful? Yeah, a little bit. If you're holding for that, that's a number of months. If you're holding for that amount of time, you're either a long-term trader or an investor. An investor is buy and hold. And maybe we go to the higher time frames. And we see here where our stochastics now bounces. Now we see the benefit in the range-bound markets. This is range-bound, okay? What's stochastics doing? It's hitting the highs, it's hitting the lows. It's showing you where they are so that you can trade them appropriately. Now, when price gets back up here, what's happening? Stochastics is staying in the overbought area. It's holding there. It's not breaking through. So we can find times, here's oversold and holding, oversold and holding. Classic, overbought and holding, telling us that even though we got here, we might continue because we're staying above that line. We have not broken down below, telling us to go short, or not. Well, in that case, yeah, go short, or conversely go long in that. So there's how we can use the different time frames to more accurately take advantage of our studies and looking at what the market is doing for us in that scenario. Okay. Let's see, what else can we find? And again, this is how I look at it. I tear apart a chart, look at what the indicators are doing. What are they telling me here to confirm what is happening on here? And then I go from there. All right, sorry, 1 second. I'm trying to make my water last. Actually, I should do something else. I should grab a mint here while I'm thinking of it. Hang on. Therefore, we'll have to leave. All right, so now let's look at some areas of where price is continuing, but the indicator might be telling us that that trend might be coming to an end. Hang on. Okay. Let me help lubricate my vocal cords. Here we have a nice downtrend within this chart. Here's a swing low, pulling back to a swing high. We get overextended, we're going to pull back. Okay. Oh, this is why I like crosshairs. Crosshairs allow me to key in on a particular candle or to find those flat levels, such as this one, which I used to put in our lines. My crosshairs can help me with that. So I like that, and I find that right here, crosshair, I click on that, and that's what, so anyway, that's what, rather than just the arrow, which is helpful, personally, I like crosshairs. Anyway, back to the program. All right, so here's that low, that swing low. We pull back, we get that swing high. All right, what's the indicators doing? MACD in particular shows it's coming down. It's following this leg of the trend. This swing low matches this swing low. All right, now price moves up, the indicator moves up. Okay, that's fine. I don't care. It's going to do that. This is in a downtrend. I'm concerned with this, or with a or an indicator. My English teacher would not be happy. An indicator. One sec. Sorry, didn't want to cough in your ear. Now that price has come down to here, and we have that pullback. Okay, the downtrend is still intact from a chart perspective. Okay, lower lows, lower highs. The question as a trader is, and making a decision, if I were going short in this example, and the mirror image holds true for an uptrend as well. if that's the style of trading that you're doing. Will this, I'm right here, okay? Actually, let's do this. This is fun when I can do that. Okay, now we're looking at this in real time. Price has pulled back up. I'm thinking, should I go short thinking that this is going to continue in this direction? Well, I use my indicators to help me confirm what is going on within the chart. We're going down. All right, MACD says as of here, we're going down. Come back up, we come down. Now, what is the indicator doing? Price made a new low. Did the indicator also make a new low? No, it didn't. This is a higher low compared to here. That is telling us that maybe, yeah, back to those weasel words, maybe this trend is done. Now, we know that price goes in one of three directions. It goes up, down, or sideways. We don't know where price is going to go from here, but our indicator is giving us the tip that maybe price won't continue to go lower. It might, but what we're showing from the indicator, what the indicator is showing rather, is that sooner rather than later, this trend is done. It might be now, it might be soon, but the point being is we're at a higher risk of trying to go lower than saying, okay, I better not go short at this junction because my indicator is telling me that maybe we're done. How did that play out? Played out beautifully. This indicator kept us from making a decision to the downside. Now, it doesn't mean that it's automatically going to go higher, because we could go sideways, right? So it may go sideways, but the point being is we don't want to go short, okay? We also have our support and resistance lines in there, but we're not talking about that today. So just from an indicator perspective, that's not making a lower low. How about RSI? That also did not make a lower low. It stayed even, which, because it has that range, when it gets to extremes, it can make it more difficult to continue. So we have to take that into consideration. But it did not make a lower low. So we combine these two and say, okay, maybe this is the low. I'm not going to go short any further. I'm going to wait to see what is going to happen. So we find here's our low, there's our higher low, there's our lower high compared to here. But once we break that level, we have a higher high, and now we can say from a chart basis, our downtrend has ended and we are now in an uptrend. And again, depending on your particular strategy and setup, you would be looking for opportunities there to buy into this uptrend. Let's see if I can find, oh, right here. So over here, it's kind of flat, but what's the indicator doing? In this case, RSI is making lower highs, saying that maybe this is done. Now there's another side range-bound market. Maybe stochastics would be better in that example. Here's an example. Here's a high, here's a higher high. Is our indicator confirming this movement? Price action is showing higher prices. Do we have that on the indicator? Here's the high, here's a lower high. Here's a high, here's a lower high. No. So if we were considering buying this market in anticipation of higher prices, looking at the chart, only, we would say, well, that made a higher high. From price action basis, we have an uptrend as of this junction. Again, let's do that. So as of that junction, actually, let's squeeze that a little more. There we go. We're saying, okay, we might be going higher if capital I, capital F, underline, if this was the setup, would this be the time to buy? And I'm not saying it is, that looks like a lousy time to buy. But hypothetically, just for our purposes of discussion, would this be the time to buy? Higher high here, lower high here, higher, lower? The answer is no. We would not buy this market at this time. And lo and behold, prices went down. Not the time to buy. So in that case, on the uptrend, the indicators, the studies helped us to stay out of a bad trade. So that's obviously positive there. Let's go to the lower time frames in case anyone is in that category. And we can see our support and resistance lines carry over, which is nice. That's the benefit of using the higher time frames. Now, here's an example of where the studies did not play out. Here's a beautiful uptrend. And while this is high, it did not make higher highs. Neither did MACD. So this is a weak trend, but stochastics did not hold. It stayed above or kept bouncing above the overbought area, but we didn't get the signal there to go up. Let's see, is this, it's somewhat flat right there through here on RSI. Our higher highs, not higher highs, our high peaks within the red line there, somewhat flat. Yeah, that's a tough one. If we were trading this time frame, we might have missed that. Here we're looking for lower lows. Beautiful indicator following price action. Looks good. And then here it bounced down, it bounces up, and price action takes us in a new direction. The indicator did not give us foresight as to that happening, but price action did. So we would not have been able to enter a short position here because price didn't allow us that opportunity. So that would have saved us from a bad trade there. All right, let's go back to daily. Let's try another market. Let's try Meta. I don't know. I've got a list here and I'm just, whoops. Come on, can't type. Here we go. As I said, I'm just picking out things and looking for them. I'm not having things predetermined for you. I want to show you how I'm doing it and how I look for it, and hopefully that makes a better impact on you, or with you rather. Maybe that's a better way of saying. Has a better benefit. Now, here's a chart that has a number of gaps in it. There's a big gap. Here's a gap. There's a gap. There's a smaller gap. Gaps are tough. Let's get rid of that. Oops, and get rid of that. So these, that can be challenging. I'm guessing, let's see, what's this? This is 2 and, well, I don't know, that might be earnings. I'm not sure, some kind of announcement, obviously. There's another one there. Here's a side note for you. It is our responsibility to know when companies are making these types of announcements, such as earnings, as an example. We need to know that because if we're over here, just hypothetically here, we're over here and you see price going up and for whatever reason, you think, oh, I think it's going to go higher. I'm going to buy this market in anticipation of higher prices. Well, you buy on this day, not knowing that this announcement was coming out, and you buy, ouch. Even if you had your stop loss in place, even if it was there, I'm making this up, even if it was there, you still had a world of hurt. So my point being is, it is our responsibility as traders to know when these types of announcements are coming out and to trade accordingly or not to trade accordingly. If you knew that this announcement was coming out here and you went flat on Meta, and then it came down here, then it gave you the opportunity, if you were a short seller, to go short with the market. Conversely, over here, well, those are all lousy examples, but mirror images anyway of the concept with that. Okay, little side note there, hopefully that helps. Let's see, here's a beautiful trend. What are our indicators doing? There's a higher high, slowing down. As again, price moved up, but then it did slow, and then finally. So as I say, it's going to happen sooner rather than later, and that's what happened here. It did happen, but not yet. MACD continued to move up on here, not tremendously so. Again, remember that MACD does not have a limit on the range, so it can continue in that direction, positive or negative. Let's see. So there's some range-bound markets. Let's see what Stochastic is doing for us here. There, Stochastic's pinpointing the high right there. It drops following this. Here's our bottom line where we're bouncing. Let's see what Stochastic does there. Actually bounced back here, told us to get up. We would have been okay. This low is higher than that low, so we could have potentially made something out of that, holding this obviously for a few weeks. This red and green line, it keeps alternating, is current price, so don't confuse that with a support and resistance line. Let's see, so right now, well, we got our moving averages crossing, so that's not helping us too much there. That's telling us not to buy. Let's see. Let's look at this downtrend. What's going on here? Big now. See, now this is, we have to, as my finance teacher used to say, we have to massage the numbers. Well, here's the massaging part. We just had a big gap down right here, from here down to here. That activity is going to influence our indicators tremendously. So when we see that, we have to recognize that our indicators are going to be a little bit skewed due to this gap. So take that into consideration. Let that solve out a little bit before you make your decision as to which way you're going. So that didn't offer us too much for education. Let's go to somebody else. Oops. There we go. Let's try Google. Let's see what's going on there. Okay, we've still got a few gaps here and here. Those might, I'm not sure about some, these little gaps. Let's see, is that I don't know if that was a weekend. That might have been a weekend. That looks to be normal, or when I say normal, normal for this particular stock. Google has a lot of little gaps in between there. So if you're going to trade Google, recognize that this can gap either in your favor or not in your favor, depending on how things are going. Most times, let's see, that's in the favor, that's in the favor, or that's, I should say, that's in the direction of that movement. That one is. So this appears to be gapping, at least on this time frame and this chart, gapping in the direction of the trend. So if you are trend trading, this would most times this is gapping in your favors, which is always nice. But we're here to talk about indicators. Oh, I've got to talk about, before I forget here, Fibonacci retracement. Wow, let's look for an opportunity here for Fib retracement. Let's see, go. And there it is, Fibonacci retracement. Okay, first thing I'm just going to do, whoops, I didn't want to do that. No, I don't want to do that. Come on. There we go. Let's try that again. There. Okay. So now, this is my starting point, and I'll show you where we do that on the chart. This is my starting point. This is my ending point. I always extend my ending point because this part is the future. Here is current, here is the future. So this would be extending over this way into the black abyss, and that would show you the future. So I'm starting here, I go up to here. If price, and this is what price action does, it goes from this level to this level. If price comes all the way back down to this price point, that, and you can see right here, this price point, 78 point, what's that, 7, and we come over here, we can see that's what it is, 78.79. So that's following, that shows you what price it is on the scale. But if price goes up to here, this is where we put our retracement tool, and then pulls back, that would have been a 100% retracement. We went up, we came all the way back, that's 100%. This 236 is 23.6%. So if price goes up to here and pulls back to this level, it would have retraced 23.6% of this distance right here, okay? That is a weak retracement. My suggestion is I personally don't trade that. 38.2 is a little better. It's a little stronger. It's a deeper pullback and can then offer a greater opportunity for movement in the direction of the trend. In this case, this would be an uptrend. 50 is not actually a fib number based on the sequence, but because price retraces to that level so much, it's added for the benefit of the indicator, the study. And then the 618, the 76, I ignore. In fact, you can take that out if you choose to. So 38.2 at a minimum, 50 and 618 is best. All right, let's get rid of that. Now let's go see if I can find one. Here's a low point. Now I put my cursor there and left click and release and go up to here to this point, this high point, and then I pull it over like so. All right, now the reason that I pull that over is that this will be like so, as an example. So we don't know how far that's going to pull back. I have a low point, I have a swing low, and I have a swing high. Now I'm going to look for price to pull back to what percentage that is that I'm looking for. If you're looking for a 50% pullback, then if price pulls back to the 50, then you're going to see if that's an appropriate point to buy. If you're looking at the 618 and price pulls back to there, you're going to look to see if that is an appropriate place to buy. Personal opinion, if it breaks below 618, I'm not interested because that opens the door to a round trip and that doesn't help us any. So how did we do on this one? Well, we hit the 50 there, but we also hit the 618 perfectly twice. And then what happened? Off to the races. So that shows you picture perfect how Fibonacci retracement tool can show how that picks up. This is a challenge to use on the lower time frames because it's so quick. You may not have time to get into it. If you're thinking about using the Fib tool, or they also known as a Fib study, I would practice with it on the higher time frames, see how it plays out, and then you would have guidance of how to use that. But just as a random thought, there's a picture perfect place of how that played, and away we go for that one. Okay. That concludes my comments. I want to thank everybody for attending. I now turn it over to you. If you have questions about what we discussed today, please go ahead and type your questions in the question box and we'll see what we can do. While we're doing that, our last slide here is showing you the phone number for Capital Markets, the email, and they are on social media. I'll give anybody another minute or so in case you're typing away. Okay, I don't see any questions. So with that, I want to thank everybody for coming out today. I wish you well in your trading endeavors and hope you get to become the type of trader you wish to be. With that, have a great night. Take care.